This past year, I helped 24 clients implement indexing as a strategy, and if you have any confusion at all on fixed indexed annuities, we're going to walk through front to back. What are they and how do they work? First, we need to understand that there are many different types of annuities. There are very good annuities, and primarily there's much worse annuities. The first type is a SPIA, or a single premium immediate annuity. These are where you put money in and you immediately start receiving income. The second is a DIA, or a deferred income annuity. These you put money in, there is a deferred period of time, a certain number of years, and then you start receiving income. It's important to note, once you turn on income with these types of annuities, there is no death benefit. If you pass away 1 year into receiving this income, your heirs are not going to receive any money. The second type are fixed annuities. They are just like they sound. You put money in and you get credited a fixed rate of interest. In your traditional fixed annuities, that fixed rate will change year over year based on interest rates. And then there's also your multi-year guaranteed annuities, or your MYGAs. In these, you are locking in the rate for the entire period, anywhere between 3 and 10 years generally, which functions similarly to a certificate of deposit at a bank. With both of these, of course, you always have the option to annuitize. The third are variable annuities. These are like they sound. They are variable. That is because you put money into these, and part of it is going into the market. When the market goes up, your account goes up. When the market goes down, your account goes down, hence the term variable, and you have the option to annuitize. Fourth and finally, my favorite, what we're going to cover today are FIAs, or fixed indexed annuities. What's unique about these is the way that they grow is they are linking to an index. They are not going in the index, but just linking to it with a floor of 0%. Meaning if that index goes down, you won't lose any money because of that, and they will match the performance of the index if it goes up to a cap. We'll get into that a little bit later. Before that though, how are these policies funded? There's two different types of money that you can use, non-qualified money and qualified money. That just refers to after-tax dollars. So if you got a paycheck, you paid taxes and then put it into an annuity, that would be non-qualified. If you had money, you put it into a 401k pre-tax and you rolled that over to an annuity, that would be qualified. The non-qualified money, however, is taxed last in, first out. That means when you do go to annuitize this or withdraw money, the most recent money that you gained has to come out first before the initial money you contributed. On top of the type of money, you can also fund these with lump sums or ongoing contributions. If you're going to do ongoing contributions, I think there's almost always a better option, but you can do that. And then also with the non-qualified money, if you're going to put in money that's already after tax, again, I think there's better options. Most annuities are being funded with qualified money or pre-tax dollars. Now that you have money in the policy, that money is going to start to get credited interest. This is possible just like it is for banks. Banks function because people put money into them. They take that money, invest it, earn a rate of return, and therefore are able to credit you a little bit less than what that is. Insurance companies function the same way, with fixed indexed annuities, with fixed annuities, with certain cash value life insurance products. They use the premiums or funding amount to earn a rate of return, and that's how they're able to afford crediting you interest. They're doing this by investing in things like loans, government bonds, real estate, and the investments for an insurance company by law have to be much safer than those of banks. This is because their loan-to-value ratios have to be much lower, making them as an institution much safer than keeping money in banks. And to farther this point, even banks understand this. That's why they're keeping their serious cash in cash value life insurance, otherwise known as bank-owned life insurance, and they access money out of that. So when it comes to safety of the institution, we're in the right spot, getting credited interest from the insurance company. And to follow the name fixed indexed annuity, this is the stage where the word fixed comes from. We're getting credited fixed interest. If you wanted to just keep that interest and let that continue to compound, you could do that, but that's what a fixed annuity does. This is a fixed indexed annuity. So now let's get into that. The indexed portion is happening through options. So we are using only the interest that we got credited from the insurance company to buy these options. The idea here is whatever happens with this money that we buy the options with, if we lose it all, it's not a big deal. Why? Because our principal is never invested in anything. Our principal is just getting credited interest, so it's safe. If we link to an index and it goes down 40%, we didn't lose a dime due to that. Now let's get into how options work and we'll kind of circle back here. So first, if you had a home that was worth $100,000 and I wanted to buy that home, but I didn't want to buy it today, I wanted to buy it a year from today. What I could do is I could pay you an options budget. Let's say in this case, it's $3,000 or 3% of the value of the home. Now, here's the glory of this. What this allows me to do is decide or have the option, that's where the name comes from, to purchase this home for the price it is today, a year from today. So if the home goes up in value, let's say to $110,000, am I going to buy the home for $110,000 when I could buy it for $100,000? Of course not, I'm going to buy it for $100,000. Now in this case, what you'll notice is since I never invested the full $100,000, I never put the whole $100,000 into the home initially, it was just sitting on the sideline getting credited interest. I never risked that $100,000, but now I can buy this home for $100,000, but it's worth $110,000. That means I just made a 10% gain on my $100,000 without ever risking it if the home were to go down. Now, let's say the home did exactly that. Let's say the home, over this 1 year, went down to $80,000. Am I gonna buy this home for $100,000 when I could buy it for $80,000? Of course not, I'd rather buy it for the much cheaper price. So in this case, I still have $100,000. Why? Because it was never invested in the home. All that I lost in this case was that $3,000 that I paid you to decide if I wanted to exercise that option at the end of the period. In this case, of course, I wouldn't. And the same thing works for an index. So like the S&P 500, for example, if I paid you an options budget at $3,000 and the S&P 500 over the course of 1 year went up 10%, I would have the option to buy the S&P 500 at the price it was a year ago when I purchased the option, right before it went up 10%. Am I going to do that? Of course I am. I just gained 10% without ever risking my principal. In the other case, if the S&P 500 goes down 40% in a year, do you think I'm going to exercise that option and buy it right before it crashes? Of course not. Since I have this information, I'm not going to do that. I lost the $3,000 that I paid you, but that was just interest. My whole $100,000 is completely safe. Now, once I have made a gain, so let's continue with this scenario where the S&P 500 went up 10% here. Now I have $110,000. What we're actually able to do when we're using this strategy of indexing is lock in those gains, make that our new principal, and reset. Now, instead of getting $3,000 of interest, I'll probably get $3,300, and this is going to be our options budget for next year. This means if the S&P 500 the next year goes down 30%, not only am I not going to lose the initial $100,000 that I put in, but the $10,000 gain that I made last period is still locked in. Think of this like a ratchet wrench. When you turn the wrench to the right, the bolt is getting tighter. When you turn it to the left, when the S&P 500 goes down, the bolt doesn't get any looser, it stays exactly where you tightened it to. Then, when the S&P 500 goes back up, when you turn the wrench to the right, the bolt gets tighter again. Same thing with indexing. That is called locking in your gains and resetting. Next, there are many different linking methods or terms that you need to be familiar with that we can choose when we are selecting an index. Those are participation rates, cap rates, spread rates, and growth accelerators. The first, participation rates, are the percentage of the index's gain that you will receive. So if an index performed at 10% in all three of these cases and had a participation rate of 50%, well, we're only going to get 50% of the 10%, which is 5%. If we had a 100% participation rate and the performance was 10%, then we will gain 10%. If the participation rate was 200% here, then we would gain 20%. Next, we've touched on briefly are your cap rates. These are the highest gain you can make for the given linking period. Usually they're going to be 1 year, but sometimes there's 2 year, 5 year, and even monthly linking periods. But if it was a 1 year linking period and the performance of the index was 5% and there was a cap of 10%, since we have a cap of 10 and there's a floor of 0, remember if the market goes down, we can't lose. Since we are in between that floor and cap, we will match the performance of that index. So in this case, we would get 5%. Now, if the index went down 20% and there was a 10% cap, remember we have that 0% floor, So in this case, we would get credited 0%. Now, the downside to these to keep things balanced is if the index performs at 15% and we only had a cap of 10%, we can't go above our cap. In this case, we would only get 10%. Next are spread rates. These are less common with annuities, but that is the amount subtracted from the index's gain, not below zero. So if you had no spread and the cap was 10% and the index performed at 13, well, in this case, we would only get 10% because that's our cap. Now, the advantage here is sometimes you can have just a 1% spread for a little bit higher cap. Now, in this case, if that bought a cap of 13% instead of 10 and the index performed at 10, well, the downside here is when the index doesn't perform higher, we only get 9% to where if we had no spread, we would have got the 10 as you can see above. Where there's an advantage is when you have the 1% spread, 13% cap, and the index performs above that 10%, let's say 13. In this case, you would have received 12%, while if you hadn't had a spread, you would have just gained that 10%. Now there's also indexes with much higher spreads for no cap. So in this case, if the spread was 7.5 and the performance was 30%, you would have just gained 22.5%. Your money was never at risk. However, if you hadn't had that spread, you would have only got the 10%. Now where this gets dangerous is when the index doesn't perform well. These uncapped spreads are really only something you use if you don't want to miss out on a big year. When that's not the case, if we had the spread of 7.5, but the performance was 10%, instead of if you had no spread and you would have got 10% up here, in this case, you got to subtract the spread, you would only get 2.5%. Last but not least are the growth accelerators. More or less, these are similar to spread rates, but more common in annuities, especially when you're referring to the cap rate. But this is when a fee is charged or you pay a fee to increase the cap or, in other cases, the participation rate. As an example, if there was no accelerator, meaning there would be no charge, in this case, let's say you had a 10% cap, but with this certain index, if you had the accelerator, maybe that's a 1 to 1.25% charge, that would give you a 15% cap. So again, the difference here between the spread is if the index goes down, you hit your 0% floor, but you still pay the charge. So if it was a 1% charge, in this case, that would mean that you actually have a floor of -1% and not 0%. With a spread of 1%, you still have a floor of 0. With a charge, you have to pay it either way, so your floor gets a little lower. Just an option here, you do not have to do this. As a quick reminder, these are all the different terms that you can use and the different methods that you can use to link to different indices. However, most clients are simply just linking to the S&P 500, putting 100% in there, or diversifying across a few indices and just leaving it be. Usually this is something that you're going to recap at our annual reviews and see if it makes sense to switch that up. But if any of that was confusing to you, it's not something you need to have memorized. It's just so you have all the information. Now that we've covered the linking methods, there are 3 main ways that we're setting these up from the get-go. The first is if we are planning for income. We know for sure that at some time within the next 1 to 12 years, we are going to be taking income. It can be longer than that, but if we know for sure income is going to be our focus here, we want the money to grow, but we're definitely going to use it to take money in retirement, then from the very beginning, we can set up the policy in a way that's going to be most beneficial for that. What we're using is called a GLWB, or a Guaranteed Lifetime Withdrawal Benefit. This is a separate benefit base other than the death benefit or the account value that's going to grow much faster, and sometimes you can even throw a bonus on there so that when you do start to take income, it's going to be higher than if you didn't have this benefit. And also, the biggest thing here is this allows us to guarantee lifetime income without ever annuitizing. When we annuitize a policy, we are agreeing to start taking lifetime income, and if we were to pass away early, all of that money is gone. The unfortunate thing about this is if you do this and we pass away in 1, 5, even 10 years and we've received less than we even put in, most people don't like the fact that if that happens, they wouldn't have anything else to pass on to their heirs. The Guaranteed Lifetime Withdrawal Benefit is a great solution to this because this means if you pass away early, you'll still have a death benefit. You're not actually annuitizing. Instead, you have that separate benefit base, and that is what's determining how much income you're able to take. The downside to this is the crediting options are worse, meaning the death benefit that is still growing due to the fixed index strategy is going to be much more limited than if you hadn't planned just for income. That's because the cap rates, the participation rates, those are going to lower in exchange for having this guaranteed lifetime withdrawal benefit rider. Here's an example of a client of mine who went with this option. You can see here, beginning in policy year 2, they are able to start taking income, so they deferred it for at least 1 year, and then they're able to start taking the income using the guaranteed lifetime withdrawal benefits. This person put in $1 million and is 60 years old, and you can see there each year that they wait, or if he decides that he's going to work for longer and doesn't need this right away, that's a decision that he can make. The second option is you are planning strictly for growth. You're not really concerned with taking income in the future. In this case, we're not going to have that guaranteed lifetime withdrawal benefit. It's going to give us much higher caps and par rates, of course, giving us much higher upside potential, which is really just going to allow the strategy of indexing the fixed indexed annuity to reach its full potential in terms of growth. From there, when it comes to accessing this money, you still can take income with this, but it's going to be through withdrawals and not some sort of annuitization. And also, this is nice for people who aren't planning for income, because once the surrender schedule is up, if they wanted to withdraw lump sums for a donation to a church, to start a business, whatever it is, they can do that and not have to worry about reducing their benefit base, or that they already annuitized and this isn't even an option anymore. Now, the next thing I mentioned there was your surrender schedule. The longer this is, the better the indexing strategies they're going to allow you to use. The reason being, the more time that they know that they'll have your money to go out and invest and make profits for themselves, the higher cap rates they're able to give you, the more money they're able to put towards options. Usually these are ranged between 5 and 12 years, but keep in mind, this is not something that should be of any worry to you. The surrender charge only applies when you surrender the policy, when you withdraw above the free withdrawal amount. So this will vary by product and by company, but usually there is a free withdrawal, usually around 10%, that you can access each year if you wanted to. However, if you try and access more than that, this is where the surrender charge is going to come into play. Really, if you're doing this type of annuity and you're super worried about the surrender charge, it's probably not the right product for you. The idea here is to wait until after the surrender charge is over to be able to access the funds. Reason being, because after that period is up, there is no more charges from the insurance company. You always do need to keep in mind, though, the IRS early withdrawal penalties still apply before 59 and a half. So if you got one of these at age 40, it was 10 years, that 10-year surrender period was up, but you wanted to withdraw at age 51, you could. There'd be no penalties from the insurance company, but there would still be the 10% early withdrawal penalty from the IRS, just like there would be in a 401k or an IRA. After that point, of course, no penalties from the IRS either. Third and finally, if we're not sure, we have our much more flexible option, otherwise known as our options option. It's still going to have a smaller guaranteed lifetime withdrawal benefit. It's going to allow, again, just like the first option, to take a lifetime income guaranteed without ever annuitizing. Similarly, again, to the first one, this means if you pass away early, the death benefit is still there. You don't have to worry about annuitizing and then passing away early on. Because this is a smaller GLWB, though, however, it's still going to keep our cap and participation rates healthy, keeping the high upside potential. If 10 to 15 years from now, you don't need to take income and you'd like this money to continue growing, you can do that. 10 to 15 years from now, you'd like to turn this into a guaranteed lifetime income, you can do that as well. The rest is just like the growth option. This is definitely one of my favorite, especially for people who aren't sure where they're going to be in 10 or 15 years or how they're going to need to use this money. So let's quickly recap the access and transfer for each option. If you ever did decide to annuitize, which we are trying to avoid, by the way, you would not have any additional access other than the money that you are receiving, your actual income stream. If you pass away early, no money is passing on to heirs. This is exactly why we have the guaranteed lifetime withdrawal benefit and why it was created. Now, if that is turned on, you still do have access to the account value in withdrawals. However, this isn't advised because if you were to do this, the guaranteed lifetime withdrawal benefit base would reduce, as well as your account value. The income that you're taking is also going to reduce. The real benefit here is that if you pass away early on, you still have a death benefit that's going to transfer to your heirs. If you put $1 million in and you've taken $70,000 worth of income for 5 years and you pass away, you don't just snap your fingers and say bye-bye to the other $650,000. It was actually growing and it's going to transfer to your heirs. This isn't a worry. Now, if you have the guaranteed lifetime withdrawal benefit rider attached, but it hasn't been turned on yet. You can access the account value via withdrawals. There's still the penalties if you are during the surrender period, but it's going to reduce the GLWB. So if that's a big goal of yours, make sure to keep that in mind. And just as if it was on, we have the death benefit there that's going to transfer to our beneficiaries. Finally, the growth option, when you do not have any sort of guaranteed lifetime withdrawal benefit, similar to the last one, you're going to have access to that account value via withdrawals, penalties if you do this during the surrender period, and the death benefit will transfer to the beneficiary upon your death. Always keep in mind this money is taxed last in, first out, otherwise tax deferred, just like a 401k or an IRA. Now, most people don't like annuities in general because they hear about the heavy fees. I am in the same boat. As we mentioned at the very start of the video, not all annuities are created equal. That is why fixed indexed annuities are my favorites, because there are options with no fees. If you would like to add certain riders like the growth accelerator, which we went over earlier, enhanced death benefits, long-term care riders, bonuses, we'll cover those later, then there is fees that will be added, but you don't have to do this. Commissions as well are not a fee to you. I, as the agent, am actually paid by the insurance company for bringing them your business. And this is exactly why they have the surrender period, and this is how they make money. Just like banks, insurance companies take the money that you put in, they invest it, and they're splitting it into two categories. First, they're earning a rate of return, and part of that is used to credit you fixed interest. That's what we went over. That is how the strategy of indexing is started. The gain that they make, well, that is their profits and overhead. They're paying their employees, they're paying agents commissions. This is an expense for the insurance company. If an agent earns 6% commission on a $1 million policy, that does not mean that when you put $1 million in, you're only gonna have $940,000 in there. That's not how that works. You're still going to have the full million. The insurance company is paying me the 6%, the $60,000. So again, if this is a concern for you, it shouldn't be. In fact, getting a one-time 6% commission, I, as the agent, am actually earning much less than a financial advisor would, just charging a 1 or 1.5% fee, because that would be recurring year over year. In this case, it's a one-time, it's upfront, and even better, it's not paid by you, it's paid by the insurance company. And at the end of things, if you were confused on fees or how commissions or how these things would actually affect your rate of return, all we need to look at is our internal rate of return. Very simple. If there are no fees, your internal rate of return equals your rate of return. That means if you gain 7%, if the index gains 7% and they credit you 7%, you keep 7%. If there are fees, you subtract them. So if there was a 1% fee and the index gained 7%, well, then you would get credited 6. Of course, this is all going to depend on how you set up the policy from the very beginning and what your goals are. Next, quickly, we'll go through the riders. First is the growth accelerator we already went over. There's also an enhanced death benefit rider, which is a death benefit guaranteed to grow a certain percentage per year for a certain amount of years. This can be good if you're really concerned about leaving money behind, but you're worried if the policy is going to underperform. These aren't very common, but they are an option that you have. The premium bonus, you can get a certain percentage given to you right away, right when you put the money in exchange for lower caps or participation rates. This is another example of a client that I have who used the premium bonus. This was a 12% bonus, but he sacrificed, you can see on the S&P 500 here, his cap rate was only 6.5%, so it was lowered, but he did that so that he could have the upfront bonus. This is an option you can do. And then many policies, they'll have a long-term care bonus where if you can't do 2 of the 6 activities of daily living, the income can be doubled for up to 5 years. Usually some nuances with these as well, but these are the riders that you could add for fees or for worsened crediting rates. Finally, with the strategy of indexing, with all of the different benefits we went over, there are, of course, some warnings to be given. The most prominent concern is going to be that the crediting and participation rates can be lowered. Contractually, the insurance company can lower these if they want to. Now, generally, these are going to correlate a little bit with interest rates, Moody's, the cost of options, these sorts of things, but it's always important to go with a company that has a history of treating their older policyholders well. Another thing is that tax treatment and penalties can be confusing with these. Of course, that's not a reason not to do them, but is something you need to look out for. Make sure you understand how you can access the money, how much. If you do, are you going to have a surrender charge? Are you going to have to pay taxes? Is the IRS going to give you a surrender charge? Make sure you understand how this works based on if your money is qualified or non-qualified. Most importantly here though, the whole idea with indexing in itself, and especially with fixed indexed annuities, is you should not be trying to hit home runs. This is a vehicle to hit singles consistently. A lot of people will use them as CDs or bond alternatives. They can give great returns, but don't count on them to. These are great for income and great for reliable, protected returns. Hopefully this video was helpful. If you have any questions at all on how fixed index annuities work, the nuances of them, drop a comment below. I'll make sure to respond to each and every one of them. If you'd like to take a look at what one would look like for yourself, how it could affect your retirement or your income in retirement, book a 20-minute quick consult with myself down below. I'd be happy to help. Bye-bye.